you balance that out. So let's get into assets because a lot of folks don't know that there's other ways, especially my first time home buyers. They don't know, they don't know that there's other options to get closing costs covered. There's other options to get down payment help. They're only looking for down payment assistance programs, and those aren't always going to be your one all be all solution, okay? Because I'll tell you here, one of the most common things, especially with first time homeowners, some with those that have owned homes in the past, one of the most common things people think that they have to pay out of pocket is down payment. And they feel like if they get a loan that has zero down, that they shouldn't be spending anything out of pocket. And a lot of folks forget that there's a thing called closing costs, because everybody involved in the loan, they're not working for free. Okay. You got the title company who has to record your deed with the courthouse. They have to schedule and arrange your closing. They're not doing that for free. Those fees are passed to you. All right. Because you're the one buying the house. All right. You got your loan officer. They're not working for free. You got the banks. Those are all a part of closing costs. Government fees. Yeah, you got to pay government fees to buy a house because they're recording your deed. They're going to be doing a whole new, well, not a new survey, but they'll be putting in a new title insurance policy, your owner's title insurance policy, your lender title insurance policy. All those are a part of closing fees. Okay. Or as they would call settlement cost or investment cost is what I like to call them when I'm working with my clients, is an investment cost, because that's the investment to you buying a home. You have to give some more money. Now you want to keep those costs as low as possible, but those are all included in out of pocket expenses, which you need to show the assets to ensure you're able to get the mortgage, especially when it's a purchase. A refinance, you already have the home. So assets are reviewed and utilized, but not in the same way on a purchase. Um, Not in the same exact way. It's very similar, but not the same exact way. So when you're buying a home and there's a down payment, or let's say there's zero down, you still have to show asset statements that can be retirement plan, that can be bank statements, that can be stocks and bonds that show that you have the money to cover the out of pocket expense. Sometimes closing costs can be $15,000. So let's say you get a house for $550,000. 1% of that is $5,500. Closing costs sometimes can be 3% of the loan. That's 16.5. That is realistic. That is realistic. That you're still spending $16,500 for a $550,000 house and you haven't paid any money down. Now, let's say you're getting an FHA loan. And let me pull up my calculator again so you can see that just on a basic calculator, because I'm a hands-on learner, so I like to see it and go through it as someone's teaching me. I like to do that. I'm not sure if everyone else is that type, but let's take a look. So $550,000. Matter of fact, let's make this the whole screen. $550,000, right? Hold on, where'd it go? All right. Times minimum FHA down payment is 3.5%. All right, so you're gonna need 19,250 for your minimum down payment. Okay. Now let's add that 16 grand for closing costs. All right, so you're gonna need roughly $36,000. Now, do you have that in the bank? Some folks that I work with, they do. I'm gonna be real with you. Some folks I work with do have this and more. Gonna keep it real. I'm gonna keep it real. I'm gonna keep it real. But if you don't, do you have this in your 401k? Do you have this as it pertains to a sum of both? Like, do you have maybe 8,000 in the bank and 22,000 or 25,000 in the retirement? Let's say you don't. Let's say you're working with me, and which this has happened to me before. Hey Tim, Hey man, look, I don't have a retirement. I don't have a retirement. I only have about $3,000 in my bank account. I got a 712 credit score. My debt to income is 40%. Why can't I get this house? Y'all can't just roll that in? And these are the tough challenges or challenging moments in this business. But I will tell you there are ways to roll that in. And we'll discuss that on the property portion that we'll get into later. However, rolling that down payment in, I'm going to tell you, not likely to happen. But rolling those closing costs in, that can happen. I'll break down how you can do that. So we're going to unveil some of the tips and codes and things that people aren't aware of, but I'll show you that. Now, one thing I do want to tell you, if you don't have the money in the bank liquid, you don't have the retirement funds, there are other ways. One way when it comes to assets is if you own another property, you can use the equity out of that property as a down payment or to pay the closing costs. You can pull the equity out of that property. Say your parents left you a home or left it to you and your brother and sister, and your name's on it. You can take a loan out against that with that same loan officer you're working with. You can pull a home equity line of credit. Let's say maybe it just has $60,000 of equity in it. You can pull some of that equity out and apply it towards your down payment and closing costs. Yes, you can. You can get a home equity line of credit, pull on that, and voila, now you have the money right there at your fingertips. That's why you need to check out my redlining stream I did, where they actually squeezed out black and non-white communities from having those types of opportunities due to the HOLC's redlining maps, where they devalued the homes in those areas, which put them in a position where they can't do that. A house they bought back in the 30s for $5,000 that now on the other side of the tracks, other side of the river, those homes quadrupled. Their homes quadrupled the other way, going down. It started being worth only $500. So they didn't get that opportunity. But if you are in a position where you have property, not just a home, let's say you own a boat free and clear. Let's say you own a car free and clear. It might be a 2010 Escalade, but if there's no payment on it, it is an asset. It doesn't have any loan on it. It is an asset. It may not give back as much value as you would like. Maybe you only can get 7,000 for it, but that is money that you can use and leverage towards your mortgage. If you want to trade it in, even take a loan out against it. That's not something I would advise as far as taking a loan out, because that loan, if it's going to be done on credit, will be included in your income profile. They're going to roll that into your DTI. But if you are, you got two and three cars, and that's one that's sitting in the garage, it runs fine, and it doesn't have any payment on it. Your assets are not where they need to be to qualify, because you need to show that you have those funds for out of pocket expenses due at closing. That needs to be shown prior at point of application that you have that. So that way you're not wasting your time and you're not wasting the bank's time. But if you need 7 more thousand or 10 more thousand, whatever it's worth, and that can get you there, you may want to take a look into that, because you need to show that you have the funds to pay out of pocket at closing, especially for a purchase. Now, another option that you can take a look at, let's say that your family did not leave you the house, right? But say your dad, mom, grandmother, whomever, say they are living in the house and they have equity in the house, and you've been a good grandchild or a good son or daughter, They can do what's called a gift of equity. They can pull out their equity in the home and gift it to you. They can give it to you. They fill out a letter that's called a gift of equity letter. They'll take a home equity loan or do a cash out refinance against their own property. They get the funds, because when you do a cash out refi or a HELOC, you can pull those funds. They can use those funds and give it to you for your down payment or out of pocket expense. And the reason, I know some folks say, well, I can just do that without going through the banks or without filling out a gift of equity letter. What do I need to do that for? I can just ask them for it. You can, but if you're looking to be qualified at that point in time, you'll need to do the gift of equity letter. And the reason being is, if you're getting a loan that's going to be Fannie Mae or Freddie Mac, and you send in those bank statements, those asset statements they need to show that you have the funds to pay out of pocket at closing, if they see a big old deposit from grandpa for $50,000, they are going to deny your loan because of the Patriot Act. It appears that you're laundering money. Although that isn't the case, that's why you have to fill out the gift letter so they can trace that. Now, on FHA and VA government loans, they'll also need to show the bank statements from the family member that gifted you the money, because gift of equity can only come from those that are in an arm's length of you. Or not, I'm sorry, I said that wrong. Non-arm length. So family member. And what they mean by arm's length is those that aren't family member, they're not arm's length of you. They're not someone you're hugging. It's not your friend at work, your boss at work giving you equity. They wouldn't consider that someone who is non-arm's length. Non-arm's length is someone that you could hug. That's how they look at it. Someone you could put your arm around. Your mom, your dad. Those are non-arm's lengths. It's not back up, get away. It's not your coworker. It's not your boss. It's not somebody that you know from down the street. It's someone that you could actually hug and not get sued for. Okay. Non-arm length transactions is what gifts of equity are for. And say your grandmother or your father um, or mother, they live in the house. The house has 100,000 in equity. She can gift you, he can gift you 50 grand of that to pay your out of pocket expenses. Some folks don't know that they have that opportunity. And there you go. Assets, now you're qualified. Because as it pertains to assets, you want to have about 3 to 6 months reserves in the bank. But if you're buying a home, you need to have your down payment and closing costs. And I'm going to keep it real with you. If your debt to income is high and your credit is bad, you're going to need your down payment, your closing costs, and at least 3 months reserves in the bank to balance that out. Is it always required? No. FHA is a little more loose on that. But if you want to have a strong profile, these are the steps you'll want to take. This is what underwriting is looking for. And they say your loans and underwriting, they're looking at these factors. All these compensating factors matter. All right. It's not just, oh, I got enough for the down payment in the bank. If the closing costs are $13,000 and you don't have that in the bank, and all you have is the 50 grand you're putting down, you're going to have a little bit of a problem, especially if the 50 grand is 3% or some minimum down payment option. You're going to have a problem. All right. Now, what some folks aren't aware of that you can use, as I was discussing earlier, one is a gift of equity. And again, that can only be from non-arm links transactions, family members, in-laws, uncles, aunts, those types can gift you equity. So think about that. If you got an uncle who retired, got a good amount of money, you think about that. Now, the thing with a gift of equity is the reason they'll sign a letter is they're saying it's not a loan. Okay. It's not a loan, that they're gifting you this. Now, whatever you and Uncle Jim or Dad or whoever, whatever y'all do on the side is up to y'all. If you want to pay him back and give him a gift back, the bank doesn't need to know about it, and you don't need to write that in the letter. but you're not supposed to lend them the money. They're supposed to gift you the money. Okay. And they can gift equity through HELOC, sale of another home. There's some folks that you may have a home in the family. You can pull off of that equity too. It's just whoever's on the estate, whether it be your uncle, cousin, whomever, they need to fill out the gift of equity letter. Matter of fact, let's pull up a gift of equity letter so you can kind of see what it looks like. Um, let's see if I can find one. And they're out there. They're all over the place. And it doesn't have to be super official. Most lenders are going to provide you one, because they want to make sure it covers everything. But it needs to cover that it's not a loan. Of course, it'll need both of you guys' name, addresses on there, the amount they're gifting you, and that it's stating that it is in fact a gift and not a loan. Um, a FHA, your family member will need to send their wherever they're getting that money wired to. So say they pull out HELOC for $50,000 to cover your out-of-pocket expenses. And when they pull that out, the HELOC funds are deposited in their checking account. They'll need to show their 2 months bank statements that reflect that deposit. Wherever that money is being deposited to, FHA requires that they do show the bank statements. Now, Fannie Mae and Freddie Mac, to my understanding, they still are not requiring on a gift of equity that they show that. They just have to fill out the letter. Okay? They just have to fill out the letter. Let me see if I can find the letter. I want to find a nice looking letter. You know what I mean? Um, oh my word. You gotta go through 100 ads before you can just find what you're looking for, man. It's crazy. Um, well, here's one. Let me pull this up for you real quick. Here's one. Um, thought I had it pulled up. Let me X some of this stuff out so I can find out. Oh, all right. And we'll just look at the document as a whole so you guys don't got to look at me. But as you see, here's a gift of equity letter. Okay, you'll put your name or the name of donor, address. Like I said, you got to put the relationship because they want to ensure that it is a non-arm length transaction. It's somebody who's a close relative. All right, and that can include in-laws. Okay, the recipient of gift. I'm gonna put your name here. That'd be the recipient. All right, will give or have given him or her a gift of equity in the amount of. I'm gonna put the amount. This is a bona fide gift, and there is no obligation, express or implied, to repay this sum at any time. These funds are available and will be given to them on and will be given to recipient of gift. You're gonna put your name again. On, you're gonna put what date it is. To close a mortgage transaction on the purchase of his or her new home. The funds of the gift or the funds which are or were given to the home buyers were not made available to the donor from any person or entity with an interest in the sale of the property, including this letter, including the seller real estate agent, broker, builder, loan officer, or any entity associated with them. See, these are all people who would be at arm's length, but it can't be anybody involved in it. It can't be anyone involved in it. Okay? It can't be anyone involved in it. But this is another way where you can tap into other assets. So if you do have a family member that owns a home, and you all are close, they may or may not be aware of this, that they can help you out with getting a home, even though they don't have the money in the bank. All right. All right. And it's a gift of equity. Okay. They can also give a traditional gift. So say your dad's been working at the plant for X amount of years, right? 30 years. And say he has 700 grand in his retirement fund. All right. And he wants to give you a gift. He can pull and take a loan out or just cash out a portion of his retirement and give that to you as a gift for a home purchase. He still has to complete a gift letter. Okay. These are just other alternatives you can use to actually purchase a home. Say you only need to take out 12,000 just to cover the closing costs. You got a zero down payment, first time home buyer loan. You found some grant or any other way. Maybe you're a vet and you get it zero down because you're a veteran, but you need the closing costs paid. And you have to show that you have the money in the bank in order at time of application. Because when they're submitting your application, you need to provide your supporting documents. And part of those supporting documents for assets is 2 months bank statements or your retirement fund or your stocks, whatever assets that you'll be using. And if it's going to be a gift, you have to complete a gift letter. And again, if you're doing a government loan, the bank statements or asset statements that were used to give you that fund, those funds need to be produced. So if a family member is going to help you out with a using maybe their retirement or using their own just liquid funds, they have to produce the bank statements, the source of funds. Those statements have to be produced. And it's a 2 month look back. So if they're getting retirement quarterly statements, they need to send in that quarterly statement. All pages, nothing blacked out, along with the gift letter that shows that it's a gift and it's not going to be repaid, when they'll be giving it to you, and producing the supporting documents to reflect it. Because saying it isn't enough. You can tell, but you got to show and tell. Okay. So keep that in mind. It's showing and telling. So these are other assets, other options to use assets. One big one that I use that a lot of folks aren't always familiar with is retirement. Because a lot of folks who actually leverage their 401ks, their thrift saving plans, their 403bs, who are leveraging those appropriately, their pensions, they may have enough money to cover the closing costs and down payment, but they're only looking at checking and savings, and some mediocre or just unfamiliar loan officer may not make you aware of that you can actually use your retirement. And like I said, you can typically, I believe it's 85%. Banks have certain guidelines and restrictions on how much they can use. But just keep in mind, if you have quadruple the reserves. Now, one thing I always ask folks when I'm doing a mortgage is how much do they have in retirement? And sometimes it can be an uncomfortable question because they're like, I just met you 30 minutes ago. You're already all in my business. But keep in mind, the whole point is taking the application to go over your ability to repay the loan. It's about your ability to repay the loan in the income, property, assets, and credit sections. And assets is a major player, especially when you're purchasing a home. You have to be able to show that you have assets to buy the home, that you have reserves in the bank. Keep in mind, and this should just be a rule of thumb in general, that you would want to have 3 to 6 months of reserves, house payments in the bank when you have a home. Because if anything were to happen, you need to be able to at least give yourself 3 to 6 months where you can still pay bills. Let's say you lose a job, and it may take you that time, maybe more, to find a new one. But at least you know you have a few months to carry the boatload. So that should be a rule of thumb, just off general principle. But banks look at that as well. Lenders look at that as well. How many housing payments do you have saved up? They also look at, do you have the funds that are needed out of pocket to actually close the loan? And that's your down payment and closing costs. Those are out of pocket expenses. Your 401ks, your retirement plans, those you actually, in a lot of cases, can leverage those without getting penalized by the 401k holders, the retirement holders, because you're buying it for a house. Typically, you have to show them your loan estimate. You have to show them that you're going through a loan application. And usually they want to see the loan estimate, not just the uniform residential application. They want to also see the loan estimate, so that way you're not being penalized for cashing out earlier or for taking a loan out against your home, or against your retirement. I'm sorry. So yes, the goal is home ownership. So you usually will have favorable terms when it comes to leveraging your retirement plan in order to pay your down payment and your closing costs. A lot of folks don't know that they can leverage their retirement. Some don't want to, but if you really want to get a home, and you should, because that's one way that you can pass down generational wealth. Like I said, you were able to give that gift of equity to your children at some point, and be able to leverage that as a financial vehicle, and your house can be an asset to you. But if you're wanting to do that and you don't have the closing cost in your checking or savings, and you don't have grandfather, uncle, mom, dad, whomever, you don't have that in order to pay your down payment and closing costs, then but you have it in your retirement, you can leverage that. You can leverage that, because keep in mind, if you're using your home as a financial vehicle, even though what you may have lost a little bit in your retirement, you're going to be building another asset with the home ownership. Because if you're buying a home, which I would suggest you do, that's going to improve in value, increase in value, then you'll be making that up with your home. And if you just took a loan out against your retirement, you'll be replenishing that account anyway. And you'll be making now you have two investments going on. You got assets because of the ownership in your home, and you've replenished your retirement account. So I would 100%, and a lot of loans that I do with clients, they typically are using their 401ks or their retirement plans, and they leverage that asset for their down payment and out of pocket expenses. So bringing up the calculator again, let's say, and we're just talking about asset qualification. All right. We're just talking about asset qualification. We'll be going into loan to value, and we'll be going into credit, but credit's pretty straightforward. So we won't be spending a lot of time on credit. Just going to be real with you. I know that everybody thinks they need to be worried about their credit score, and they fail to realize if you have an 800, but your debt to income is 85%, you're not getting approved. It doesn't matter that you have an 800 credit score. That is only one piece of the four-piece puzzle. You need more than just credit.